There we go.
All right. I feel like we need to do some overlays and stuff.
Yeah.
Yeah. Look
Oh,
at
there we
that.
go.
Wow. Everyone says I'm running for office. Oh, look at that.
Awesome. Great picture, Ari.
Oh
Great
no,
You guys did a
headshot.
really pumping job,
you have
actually.
the wrong overlay on that. It's co-founder and CEO.
His co-founder's gonna beat his ass when
Exactly. No, I know exactly how that feels, man. Like when you have co-founders and you're like founder, in like public spaces, and people are like, your founder's like, hey man, there's me too.
It takes a village. It takes a village.
All right, since we are live, let's get this going. Ari, welcome.
I did like fix that, but I guess we just put up the wrong one just for today. But just to be clear, Ari is a co-founder.
Thank you for that up.
All right, welcome anybody who's watching, I guess, and we're recording as well. Ari Rubin of Flock, really wonderful to have you here on the BluePrint sessions. I am Rob Hahn, obviously your host, and with me are two experts who are going to hopefully do most of the talking. Just very briefly, although people might have seen Lynette, what's your background? What's your expertise? Why are you here?
Background, so I am a recovering MLS Association executive for the last decade, 12-ish years, I guess. And now I am the managing partner for Reach, which
Wonderful.
is a prop tech scale-up accelerator.
Great. Albert.
Oh, okay. I'm Albert. I'm a tech guy, startup guy. I'm not a tech guy because I can't code.
No.
So I'm not a tech guy, but I'm a startup guy. So I'm a founder, a co-founder, just like Ari was. So I co-founded a startup, and I did that for about 10 years, 8 years, something like that. And then I was head of Google for startups in Korea. So my experience is mostly in Korea, but I think a lot of it translates everywhere. Like the startup DNA, it's similar.
Yeah.
All across the world. So that's where I'm coming from. And realistically, what I'm doing now is I teach golf. So
yeah,
that's very proud to be an amazing golf teacher.
All right. And then obviously the most important, our guest, Ari. Ari, since, like we talked about in the pre-show, we didn't cheat. We know nothing about you or your company. So tell us about both you and your company.
Awesome. Well, first of all, guys, thanks for having me, and also thanks to Drew, who I thought would be here, but Drew from the Mastermind. Yeah, he's got a great network there. So
yes, he does.
To be a part of that. A little bit about myself before we go into Flock. I've had a little bit of a circuitous journey to get here to where I am today. I think a little more than most people. I grew up in Chicago. And after college, I started actually in the Israeli military, where I had dual citizenship. Wow. So I served there for several years, and then came back to the States and started my career working as an analyst in a hedge fund. And I was a volatility derivatives trader.
Okay.
So something totally unrelated to single family and to real estate. Just sort of through kind of serendipitously fell into this role as being the portfolio manager at this hedge fund. The fund did very, very well, kind of through a lot of luck and a little bit of skill. But we grew the fund to a couple $100 million under management, had phenomenal returns. And it was around that time I was living in Denver, where I was working at this fund. I was starting to, I loved what I did. Philosophically, I loved trading risk, and I loved the responsibility, entrusted in me to manage money. And I worked with a lot of smart people. But I didn't really think that I was solving a problem at all. Philosophically, I loved what I was doing, but I wasn't really solving a problem. And so living in Denver, I started to encounter this personal problem that I was dealing with, which is I wanted to buy a house. And I approached homeownership and real estate investment through the lens of being, again, a derivatives trader who thinks about volatility and portfolio construction and risk mitigation and risk management. And to me, it made no sense how I could essentially put a huge chunk of my savings into one individual asset, into one single family house that I was going to turn into a rental in one market. And I mentioned Denver specifically because Denver has been such a hot market over the last couple of decades. And my experience and my viewpoint was very much tarnished by my experience growing up in Chicago. My grandma was a realtor in Chicago, and my parents owned some rental properties in Chicago. And as you guys know, Chicago over the last 30 years has looked very different in terms of investment performance than Denver has. And so I realized kind of this pain point that I was dealing with personally, and saw an opportunity to sort of apply the skill set and experience I had as a fund manager to this massive asset class of single-family residential real estate and investment properties. So I quit my job and I spent a year kind of just searching into the space in single-family rentals, and went off to Stanford for business school, and left there and started Flock. So that's the brief overview of how I got to where I am today.
Okay, that's awesome. Thank you for that. I mean, wild background. I love that. I love the trajectory from, military, number one, to, hedge fund management. And I think it's, a big testament to you to say, I loved what I did philosophically, but it didn't kind of scratch that larger itch of what am I really here to do? What's my objective? So with that, I'd love to hear what Flock is. Because again, awesome. We haven't cheated. So, tell us who is Flock and what do they do?
Yeah.
What problem are you solving, Ari?
Yeah, so the problem that we're solving is for landlords who own rental property, and they don't want to deal with the hassles anymore, but they also don't want to sell it. And because obviously selling triggers a massive tax liability, selling means you lose your income, your appreciation, and all the good stuff about owning real estate. So what we do is we convert an individually owned rental property into shares in a pool of houses, kind of like an index fund of houses. And so essentially it's like the retirement solution for landlords. So it's a way for an individual landlord to keep all the benefits of owning real estate without any of the burdens. And the way we do all that is by utilizing a little known mechanism called the 721 exchange. It's similar to the 1031 exchange in the sense that it allows you to exchange your individual asset on a tax-free basis into shares in a partnership or into a REIT, for example.
Very cool. Interesting. Okay. And so tell
us then. That's
brilliant. That is. I love this. Like, I'm wrapping my head around this really, really quickly because I love the concept and the component and the philosophy around it. But walk us through exactly how that happens. So I'm a homeowner. I want to do exactly this. I want to convert my physical property into the share structure. Talk me through, how does that transaction happen? How does that exchange happen? Who then owns title on the home? How do I, as the former homeowner, get all of it? Walk me through that experience.
So before I walk you through exactly how it works, I want to just give again the sort of context and how this fits in. Like before, as a fund manager, like typically what you're doing, and it's a good thing, you're generating, you have a fiduciary duty to your investors to generate good returns for them. But frankly, I was not motivated by just creating another financial product and say, hey, people, give me money. Like I wasn't motivated by that. And instead saw this opportunity to create a financial product, but a financial product that was solving a problem for people. And the problem, and it's a problem my parents have experienced and millions of landlords in the US experience, which is they don't want to be landlords anymore, but they don't want to sell their property because again, selling triggers tax consequences, and selling means you lose your income, your appreciation, and your depreciation. And so the way it works is someone who owns, let's just say, to keep it really simple, a $500,000 rental property. So they sell Flock the rental property and they get back $500,000 worth of shares in a pool of houses. So they go from owning this individual $500,000 house to owning $500,000 worth of shares in a fund that owns a bunch of rental properties. So the seller or the owner still continues to get appreciation and rental income, but instead of it coming from their one individual asset, it comes from all the assets. And they don't own title anymore. They don't have to deal with tenants. They don't deal with property management. They're essentially converting their house into passively owned shares in a REIT or a fund.
Okay, so I have so many questions. And I'll see if I could, these are all very confused. And I say this because I'm only just like inexpertly, just very mildly aware of how these things work, right? All right, so I guess first question is that as Flock, then you're the title owner of these properties, right?
Correct.
So does this only work if the owner owns the property free and clear, or does it work with mortgages?
Great question. So just like a typical sale, if an owner owns a property, let's say that $500,000 house, let's say they had $200,000 of an outstanding mortgage and $300K of equity still in the house, we would acquire the asset, we pay off the lender, and so the owner would receive $300,000 worth of shares. We would take off the debt, and now they just own the remaining amount.
So they would own the equity, basically, of whatever property they're exchanging. Right?
Yep.
Okay.
Exactly.
So that's one. The second question then is, so they don't own real estate anymore. They just own shares, and it sounds like because they're pooling it, it will. I mean, it's basically like it will decrease their risk, but it should also limit their upside, right?
Well, it doesn't really limit their upside, and I'll give you an example. So let's say, just in the stock market, you can either own one stock or you can buy the S&P 500, which means you own a basket of stocks, right? So I guess to some extent, owning a basket of stocks, it's very unlikely the S&P 500 is going to double in a year.
Right.
Whereas one individual stock, could double in a year, right? So in that sense, you are, I guess, limiting your risk and to some extent limiting your upside. Okay. So yeah, I guess to some extent you are. The idea of diversification, though, it's not only for price diversification, so the ability to diversify between one area which is a super hot market versus one area which may not turn out to as well. It's also tenant diversification. So you'll never have an individual vacancy again, because instead of owning one house with one tenant, you own many houses with many tenants.
Okay, and then the issue becomes, before issue, do you guys only do this sort of by segment? In other words, like, is it all single family in one fund, all apartment buildings in another? Do you know what I mean? Or is it all mixed together? How do you guys do that?
Yeah, great question. So right now we're really, really focused on getting really, really good at the one product we're building. And the one thing we're focusing on right now is single family rentals in the greater Denver area. So we just launched in Denver and we only take single family. So the GSE definitions of single family, 1 to 4 houses. Okay,
so but the 720 exchange is available for any rental property. It could be multifamily. You guys just don't do it, but you could do it at some point.
Exactly. And to be clear, the 721 has existed for decades.
Right.
Large institutional owners of real estate have been using the 721 exchange through something called an UPREIT transaction. It's like a REIT. For decades, for all the reasons and all the value propositions that we're using it for, which is it's a way to get better liquidity. You now own shares, which you can pass on to different people. It's a way to transition to fully passive ownership. It's a way to defer the taxes of a sale. It's a way to diversify risk. So large institutions and large owners of real estate have been using it for a very long time. We are, for lack of a better term, democratizing access to it. We're the first ones allowing individual investors to take advantage of this mechanism. Okay,
so I guess one of the questions there is then all the risk transfers to the REIT or to you guys, to Flock, right? So I guess one of my questions, you guys aren't public yet, right?
Correct. We're not even structured as a REIT. We're structured just it's a simple operating partnership.
Okay, so like an LLC or a LP sort of type of. Okay.
Yep, and we hold all the title of the houses.
Right.
We manage all the tenants, and are responsible for the.
So, as an owner, then how do I transfer my shares?
Yep. So you transfer your shares, so you can, just like regular real estate, you can pass it on to your heirs.
Right.
You receive a step-up in basis. You can transfer the entity that owns it into a trust.
Right.
You can also redeem, basically sell your shares.
Right.
And you just get cashed out at fair market value.
And fair market value at that point would be based on the share value of the overall pool, as opposed to whatever my property was worth or is worth today.
Exactly.
Okay.
So we exactly.
Okay.
So I just have to jump in. I just have to jump in right there then, because I am so curious, because this whole thing is predicated on how do you value the individual property or the larger value of the fund?
So we leverage a combination of BPOs, third-party appraisals, and AVMs. We are never putting ourselves in a position to profit off of the value of a house, nor are we ever putting ourselves in a position to really value the house. Our goal over time is to completely shift this process. In an ideal world, we would partner with all the AVMs and a bunch of brokers to value the houses. So we put forth an offer based on all these third-party valuation systems, and that's the offer. And our belief here is, the market determines the price. There's a market clearing price. Our goal objectively is to create just a fair market value for the whole pool of houses, both when the house comes in and then on an ongoing basis. So every quarter we mark all the assets in the portfolio. We use all third-party valuation partners and third-party auditors and everything, just like any fund, to mark the assets on an ongoing basis.
Right. And then what's your business model? Are you guys operating more like a private equity fund type of deal, 220, that type of approach? Or how do you guys?
So going back to my experience as a hedge fund manager, we used to charge 1% and 50% of the profits.
Okay. Wow, nice.
It was above a certain hurdle, but I think the incentive structure in a lot of funds is totally messed up. Mm-hmm. I think fund managers are incentivized to do well no matter what, because the way you grow your business is by doing well. And so we don't charge any performance or carry. We just charge a flat asset management fee. Okay. And it's very simple. Over time, we hope to raise the asset management fee. So we're keeping it right now. It's just a flat 1% asset management fee.
Flat 1%. And then, so property management, expenses, that comes out of that 1%?
No, so we pass through so we collect every month, we collect all the rental income, and then we hold back for property taxes, insurance, maintenance, deferred CapEx, so on and so forth. We pass that all through. Okay. And then at the end of the quarter, we pay out like a monthly or a quarterly distribution.
Quarter distribution, okay. So in the calculation of those expenses, does my property being in, let's say, a low tax jurisdiction, right? Or maybe I have a property that has no HOA fees, whereas some of the other properties do. Do you take that into account?
We don't. And I'll tell you why we don't. We believe that all of these things, the HOA of a property, is ultimately baked into the price of the asset, right? If you live in a high tax jurisdiction, that is ultimately baked into the underlying price of the asset. So we believe in efficient markets and highly transparent markets, a price is a price is a price. So if you have an older house with more, deferred maintenance in it, that's baked into the price. Higher tax base, that's baked into the price.
Yeah. But so what about things like natural disasters or, like Houston, there's a flooding. Say I have a brand new house, you say it's baked into price. Hurricane Harvey hits, houses, whatever, incredibly damaged, and it's $100,000 to fix. Would the other owners that they don't care about that, or do you have to deal with that at all?
Yeah, no. That is a very legitimate. Just like there's a risk of if you live in Denver, hailstorms are quite common, and roofs have to get replaced every 7 years, right? And so I think the general principle that we apply to this is diversifying, and you can look across every other asset class diversification is it's known as the only free lunch in investing, right?
Mm-hmm, mm-hmm.
And so, yeah, in Houston, there are properties that are subject to storm risks, right? Just like in California, there's earthquake risks,
Mm-hmm.
and in Florida, there's flooding risks, and in Illinois, there's risks of state government insolvency. There's risk in any market.
Don't get me wrong. I freaking love this idea. Essentially, what you're doing is you're creating like a BlackRock or Invitation Homes,
Exactly.
for individual landlords, individual owners. So it's it's
Rob,
brilliant. Don't get me wrong. It's just I had questions.
You hit it on the nail when you say like the BlackRock. And our belief here is the way people used to own their stocks, right? People used to have a huge chunk of their savings in one individual stock. And now, like, that makes no sense. You buy everyone, you have a 401k and you buy an index fund, right? And we believe real estate ownership, especially single family, which is dominated by mom and pop investors, right? We believe that the way that people used to own their real estate will change in the coming decades.
All right. Well, I'm done for now. My dad, I'd love this thing.
Okay, so
Albert had questions.
Yeah, I do have questions. I'm listening to like this technical discussion of like kind of all the ins and outs and details, and I'm fascinated. So I didn't want to kind of jump in too much. So maybe we can return to some more of these technical things. But what I wanted to actually hear was a little bit more of the story of how the founding, kind of how the team got together, what your team looks like, how old the company is. So that's a lot of questions. But just if you can walk us a little bit through Stanford Business School, I guess this is when you started thinking of this idea, right? And maybe even getting team members together to, and even like the timeline, like has this been 2 years, 3 years, 4 years, 10 years, right? Like,
yeah.
And how the idea came around, and if there's been any evolution in that. I know that's pretty broad. Just go ahead and speak on it.
So Albert, I think as a startup founder, this will resonate a lot with you. I started working on Flock in 2018, and I had this idea in my head, which is a little bit what Rob was talking about. I thought I was building Flock for diversification. I thought that all people who own rental property are exactly like me, this nerdy hedge fund manager who thinks about volatility and risk management, right? And I thought the solution that I was building was, hey, diversify your risk with Flock, right? And I was totally wrong. I was like totally wrong on that. And so I started, going back to 2018, I started working on this idea, and I spent the year leading up to Stanford basically just doing a search fund in the space of like small mom and pop landlords and single family rental properties. And I just essentially traveled around the country looking at this space from every different angle and just asking a lot of questions and talking to a lot of people. And I was searching for that pain point. Again, I thought that people had this problem that they were so concentrated in one asset. Turns out no one cared. I mean, they see that as an added benefit, but that's not really the problem that Flock is solving. And so my biggest takeaway from the early days of launching this was that the real problem that we were solving, again, it was not that people are so concentrated in one asset. The problem is that there's a lot of people who own real estate, who are landlords, who don't want to be landlords anymore, but they don't want to sell, and they don't want to lose their income, and mainly they don't want to pay the taxes of a sale. And so for some of those people, a property manager solves a lot of those problems. But a property manager doesn't eliminate all the stresses and hassles of ownership. There's a lot of great property managers out there. There's also a lot of kind of crappy ones out there who don't really own the asset and take ownership over it, like if you were like an owner would. And so when we started, again, we went out to the market and we started kind of just testing the idea with people. And this started at Stanford, interviewing a lot of landlords. That was our main takeaway. And so I went off to Stanford, like I said, for business school. And while I was at Stanford, as you guys know, a lot of great prop tech companies and fintech companies are started out of Stanford and from Palo Alto. I spent a lot of time looking at various software solutions to solving the pain point that I was trying to solve, but ultimately didn't think that anything really sufficed and anything could really tackle the real problem, like what's at the root of this for a lot of these, what we call like retiring landlord or accidental landlords, people who sort of fell into owning a rental property by happenstance. And so we found, after pivoting into software solutions, we came back to this tech-driven asset management business, which is what we're building today. And so, that's how we got started. The team today, it's a really nice, diverse mix of people. On the one hand, we have a bunch of people who come from really traditional SFR, single family rental backgrounds. So we have someone from First Key Homes, from Amherst Residential, someone joining soon from Progress Residential. My co-founder Matt was at a real estate private equity firm based in San Francisco. So really hardcore fund backgrounds, who really have strong experience in owning and operating and pricing single family rentals. And then on the other side, building a first-class engineering team to build the tech to kind of streamline this process and make it scalable.
Okay, so your co-founders, it sounds like you have two other co-founders then, including yourself then? Is it? Yeah,
we started initially, there were three of us. And one was a classmate from Stanford. Matt is still with the company. He's my other co-founder. And there were three of us initially.
So I'm really curious, I actually believe co-founders are a big deal in the beginning because you have to convince people to give up their life to this thing, right? To this project. And having good co-founders, I think, is a sign that you're onto something, right? That, usually it's not just about friendship. If you're asking someone, hey, can you sacrifice your life for the next maybe 5 to 10 years, right? That the idea has to be good and the execution has to be pretty clear. But I'd love to hear, as you were getting your co-founders together, as you were getting your team together, what were some of the key kind of concerns you heard from them, right, about this business? Something that scared you or scared them, and how you kind of addressed that, if you remember any of those conversations. What was what I mean? What was the biggest kind of worry from them being like, hey, I want to do this with you, but here's what I'm worried about?
Yeah. So, we had I think like a lot of early stage companies, as I said, of the three of us, one was only with the company for a couple months and played an incredibly important role in getting us off the ground. He started, we were both students at Stanford. And Jake today is one of my closest friends, but he remained in school and I decided to take a leave of absence and go build this thing full time. And we mutually decided it wasn't the right fit for him at this time in his life. And I think when you're starting a company, especially when you're raising venture capital, it takes a very unique type of skill set and willingness to go on this kind of, and also just a unique window in your life. It's really not for everyone what this process is like. And so I think I feel very fortunate that my relationship with my co-founders, despite one not being with the company anymore, is incredibly positive, and he contributed a ton getting this thing off the ground. And I think that's just to add on to that. That's the natural course of any business is such that, skill sets and business needs change, and I think it's, we learned it early, but also, I think it's an important lesson to take away. And
Awesome. So just one last kind of add on. So what does the team look like now, and moving forward, what kind of, what mix of people do you need? Do you need more coders? Do you need more salespeople? Do you need more marketers? I'm curious what organizationally, what that trajectory looks like for you guys right now.
Yeah, so we're very early stage. We're really focused right now on one thing, which is delivering an amazing product to our first customers. So the first people who took that risk in joining Flock, the first person who put their house into a pool of houses that did not exist. And so we're really, really focused on delivering them awesome returns, delivering our residents a great experience, and also making sure, we align well with the community and the environments where we're operating. So that is our first and foremost, our main priority right now. And so, as I said, I've delivered or assembled really an all-star team of people with strong backgrounds from single family to do that. And also as part of that, we're conducting these really complicated exchanges. So I have another guy who joined the team from JP Morgan, who worked on exchange funds at JP Morgan, which is essentially what we're creating using the 721 exchange. So really making sure we nail that process and get really, really good at owning and operating houses, onboarding these sellers into our fund, conducting these 721 exchanges without triggering any tax liabilities. So that's our main focus right now, is really on that. But on the other side, there's then as we're doing this and we're learning a ton and we're realizing how our customers go through our workflow and what their needs are and what their pain points are, we're building a lot of technology to streamline this process and to ultimately drive down the cost for all the people joining Flock, so we can then scale this thing, which becomes the cycle of then delivering a better product, better returns to our owners, and so on and so forth. So on the one hand, it's a pure asset management, single family rental business. On the other hand, it's taking all our learnings and building technology to drive down the costs and make it a more efficient and scalable product.
So I'm going to ask one last question. I'll stay quiet for a while because I know, like, from experience, all these people would ask questions. But so it's kind of just piggybacking on what you said, and this is kind of getting technical. I mean, what's the benefit of pooling all this stuff? So when you pool all of this, is there like an additional kind of synergistic benefit for either the people coming in or for you guys? You know what I mean? Like, is there an operational excellence that you start getting at it, or is there some sort of synergy there? And on the flip side, are there any risks involved with that, right? With pooling this stuff, is there operational difficulties there, right? Like, I'm kind of curious what the plus is, what the additional plus is of getting all of this together.
Yeah, so to be clear, like within there's a lot of benefits to pooling, but just to be really clear, Flock is not for everyone. There's a lot of landlords out there who this is their full-time job. They love doing it. They're super involved. They're super savvy, and they're really good at what they do. And they should keep doing that. They love doing it, and they're really good, and they can probably generate better returns without paying a property manager or our asset management fee. That's like a big chunk. According to Buildium, roughly 50% of owners consider themselves active owners. And then the rest of the market, the rest of the landlords out there are people who either express a willingness to or desire to retire, to not have to deal with their properties anymore, or who are totally unsophisticated. They don't want to, they're not up, they keep their rents low, they underinvest in their properties, which isn't good for the residents. It's not good for the community. You have these properties that are falling into disrepair, that aren't safe. That's not good for anyone. And so what we believe we'll be able to do, and you can look at large institutional owners, institutions have the benefits, exactly what you were saying, of being able to operate at scale, to drive down costs, to bulk buy services, right? And so in doing that, we can deliver to our individual owners, to our landlords, what we believe to be superior performance over the long term.
Awesome.
And then also, I guess most importantly, Albert, your question, what are the risks, right? Because of course, there's risk to this. One of the risks, which I believe Rob touched on, is, well, if you pool together, if you have a rental property in one area in Denver and you pool together with all the other areas in Denver, there's a chance that your neighborhood is hotter than all the other areas, right? And you get better performance. And so you would have been better off just holding it on your own, right? So that's one risk. And then obviously the other kind of like risk is that, we're a startup and this doesn't work out. And to be really clear, what happens if that, startup shut down, that happens, we're really well capitalized, we're backed by some awesome investors. But if that happens, we just sell off the assets and distribute all the cash to the owners.
Got it. Go, guys.
Cool. All right. So if I can jump in now, I'd love to take the conversation in, a slightly different direction with my sort of VC hat on, Ari, if that's okay. And just get a little bit under the hood of the business. So definitely get the objective, get the goal, get the strategy. I just want to start a little bit more on you defining kind of what the actual product offering is and what differentiates you in the market from the traditional, kind of pooling REIT approach, and how technology bridges that. And then I'd love to just do a bit of a rapid fire with you on, some of those sort of key venture related metrics, if you don't mind, or business related metrics. So the first question I'd love you to dive in with is, what's the tech angle here and what differentiates you in the market?
Yeah, definitely. So I'll start with the differentiation, because this is, I think, the easiest one. There is currently no products. I guess there's one or two funds that we know that offer this to individual landlords. There is no way for an individual rental property owner to exchange their individual asset into shares in a fund. You can. So if you want to retire from being a landlord, you have kind of three options. You can sell your asset and trigger a massive tax liability. So in Denver, that's if you've owned for 30 years, you could be paying 30% plus in taxes. You could 1031 your property, but there's a lot of costs and fees and effort involved in that. And then, by the way, you still own real estate, so you didn't really solve the problem. And your third option is you can continue to own and you can hire a property manager, right? So there's really no solution for the retiring landlord to continue to get all the benefits of real estate without any of the burdens. So there's no solution for it. Where tech comes in is essentially these are really complicated exchanges to conduct, to scale this thing, to operate the portfolio at scale, to actually conduct these individual transactions. It's really complicated and it takes a lot of legal, tax, and due diligence to do that. And so, building technology that we're doing will drive down the costs and make it more accessible to people around the country.
Cool. So it's an efficiency. So the tech is enabling the efficiency of sort of this complicated process is really what that angle is. Awesome.
Exactly.
So again, with my VC hat on, obviously there's a massive capital component just on the physical asset piece. And I'm curious how you're structured. Is it an OpCo/PropCo model? So you've obviously raised some capital. I'm curious, are you raising that kind of as a split? Or are you raising it kind of under the same umbrella?
Yeah, great question. So we're an OpCo/PropCo structure. So venture dollars go into the operating company. Our PropCo is what people who are trading their house for shares in, right? This fund of houses.
Yep.
What's unique about our model is we acquire houses and we don't put cash out to acquire them, right? So someone has a $500,000 house with no debt on it. They put it into Flock and they get back $500,000 of shares in our houses. So it's not really a capital intensive business in the sense that we have to go out and buy all these houses.
Right.
Our capital is essentially just to be used to build the tech, the startup costs involved in developing this really complex legal structure, the various entities involved, and then hiring a world-class team, obviously, to deliver really good performance to our investors.
Awesome. Okay, cool. So here's the rapid fire. So I'll throw a question out at you as quickly as you can. Just throw out the answer. What's the size of the portfolio right now?
So we just launched our pilot fund. We launched very deliberately, very small with 20 houses in the greater Denver area. And the goal is just to get really, really good at what we're doing. As I said, get really good at these exchanges. Some of the exchanges we had to delay because we realized, wait, there's something that we didn't anticipate in this. It's not vanilla. And so, launched just a pilot fund with 20 houses in Denver.
Got it. Perfect. Thank you. Capital raise to date.
We've raised a little more than $6 million from a combination of individuals and some venture capital firms.
Okay. And any plans to do a further? So my guess is that's kind of like a pre-seed or a friends and family kind of an approach.
Yeah.
Is that kind of how you structure that?
I think like a $6 million. We would say like a $6 million seed round.
Seed.
Yeah, 6 million. I mean, I know value raises are hot, but still, I think 6 million is and yeah, we're fortunate to be backed by some really awesome investors. We're backed by out of New York, a firm called Primary Venture Partners, Sousa Ventures, and also Box Group out of New York. And then we have some awesome individual angels. So the CEO of Open Door, Eric Wu, the former CEO of Invitation Homes, which is the largest single family REIT, and a bunch of other just really strategic mentors, advisors, industry professionals.
Cool, very cool. And I know, I just want to address that. Like, I know, Albert, you kind of chuckled at my comment around, $6.5 billion raise, but seriously, that's how fast these things are moving. Like, institutional money isn't even looking at a $5 million round rate. Like seriously, in some of these areas. And so I'm curious how companies are kind of positioning those as well, because it is all about positioning, right? I mean, it's only a label and an amount of money that, is driven into it. It's really more about who's driving the capital as it's turning out. So, but very cool. You obviously have institutional capital on the table, which is awesome. Okay, last question, and then I'm done, is what's your growth strategy?
Yeah, so until now, I mean, we've spent very, very little on growth. We got our first 20 houses from a direct mailer, which is like the spammiest thing I've ever done in my life. And we were really, I mean, again, think about this. We had like a WordPress blog site, a direct mailer, and we went out there saying, put your house into a pool of houses that does not exist.
That's crazy.
And I think it speaks to the demand for what we're building. So we haven't turned on the growth levers yet. And again, our main goal right now is just really creating like a really awesome product and delivering really good returns to our first pilot owners. The growth strategy, though, once we turn it on, is sort of twofold. The first is direct to consumer, so just obviously direct outreach, Facebook ads. But the second one that we think will be very promising is actually through realtors. And the idea here is, as you know, inventory is at historic lows. No one wants to sell, especially some people want to sell in a hot housing market. But if you have a massive tax liability, you don't want to sell. And so we work with realtors. We're about to close our first transaction with a realtor. And the value proposition here to a realtor is you have a client who owns rental property that they don't want to sell. Here's a way for you to earn your full commission by bringing them and selling your client's rental property to Flock.
Very cool. I like that. I was curious if the real estate industry was a part of that strategy. I'm glad to hear that it's a big piece.
Yeah, I think where a lot of prop tech companies have gone wrong, like we really believe that we are aligning all the stakeholders in the single family, even property managers. Like a property manager, if they have a client who it's a bad owner and it's a bad tenant and the guy doesn't want to, or the woman doesn't want to invest in the property manager can act as a transacting broker and bring the property to Flock. So, we really believe that through partnerships with property managers and realtors, we offer like a really awesome value proposition to a lot of stakeholders.
Awesome. Thank you.
So I've got a couple rapid fire questions based on that. What is the average return right now for one of your investors? Do you guys have enough of a track record?
Yeah, so we don't have, you can look at the historical performance of the assets. The Denver market is appreciating at roughly 12% annually. The current yield on the portfolio is roughly 3.5%. So it's very standard average single family rental returns in Denver. Okay. We won't take any property. So obviously there's, $2 million houses in nice areas of Denver that have like 1.5 cap rates. We wouldn't take that house. There are certain assets that we won't take due to HOAs or certain restrictions. Our goal is to deliver like the average, or the most efficient average return of Denver real estate. Okay. And we launch other markets as well to deliver that.
All right. Second question is there a way to reverse this transaction?
Yeah. So the one downside to the 721 is once you are in an UPREIT, once you have exchanged your real property for shares in a fund, you can't then 1031 out of it. So you could sell, you could say, hey, I want to buy back the property, but that would trigger, redeeming your shares or selling triggers the taxes of the sale eventually. So, we find that most people who are coming to Flock, they're already at the end of the line. They're like, I don't want to own this thing anymore. I'm already thinking about selling it. So, we don't find that it's a big issue.
Okay. And then I guess one of the sort of rapid fire is, do you guys ever dispose the property in your portfolio then?
Yeah, great question. So once the house is in the portfolio, we now have and I talked about, obviously have a very strong sense of duty. It is our duty to generate great returns for our investors. So if we see an opportunity to sell off an asset and buy a new one or cull the portfolio and optimize it, we'll do that.
So then what do you do with that cash?
So we'll reinvest it and buy a new property.
But then you'll buy it. It's not it's not a 721 exchange. In other words, like I'm imagining, okay, you have 20 homes. One of the homes, the price has just gotten absolutely insane, right? And you're looking at this as a portfolio manager standpoint. We'd be fools not to sell it at this price, right? So you sell it, okay. But what you told me is, in order to get into the fund, I'm contributing real property. You've given me shares. The fund itself doesn't sound like it has really that much money, right? That might be at the operating company level, if I'm not mistaken that. So what do you do with that cash? Do you then go buy another real property?
Yeah.
Okay.
I mean, we operate just like any single family rental fund. So if we get an offer, we'll sell the asset, 1031 it, buy a new asset.
Got it.
We also have a credit facility. There's also cash in the fund. So
okay, cool.
Yeah, but we operate, we just go with the
Okay, so my next, it's just, I would just bring it up, right? Because it's just something, and it might be because I'm influenced by Pedro, my associate who's been hotly writing about the issues around affordable housing and lack of inventory. I mean, I love the idea, man. And for that group of the accidental landlords, right? That group of people, this is a godsend. On the other hand, I can't help but think, from a social, societal, industry impact, like one of the effects of what you guys are doing is keeping inventory off the market, right? So just think about the inheritance issue, right? Parents pass away. I'm the child. We get this house, right? And it's held free and clear, but it's 30 years, huge tax liability. I don't want to own it. I have zero interest. I don't live in Denver, right? I live in New York. Most of the time, they would just put it on the market, sell it, and pay the taxes, which means another family could move in. Under this scenario, I would participate in Flock. Now it's a permanent rental property until you guys at Flock decide to sell. Tell me,
so
how do you think about that?
Yeah, so that's a pretty fringe case. I would say to focus on more of what is the typical case of most houses, which is these are rental properties that someone owns and they will never sell. The landlord is in their 50s or 60s and they have no intention of ever selling this thing. And instead it's sitting there. They don't invest in the property. It's sitting around. It's bad for the neighborhood. The tenants aren't great. And by the way, they don't live in great conditions because the owner doesn't invest in it. What we're doing is making that a better, more livable asset. So I actually don't think we're contributing. It's a great question. I think we're not competing on the MLS for inventory. And I actually would position it differently, which is that I think a big factor in the inventory problem is the fact that there's so much institutional capital going into single family rentals, right? Mm-hmm. And the problem is they're on the MLS and they have better access to the MLS and to the iBuyers, and they can buy these houses way quicker than any family first-time home buyer can. And so institutions are buying off the open markets, taking these houses away from first-time home buyers. Whereas what we're doing is we are creating this other channel to get supply for institutional investors, but get supply into our fund, which is by taking already existing rental properties and turning them into new rental properties.
Okay,
so I think where as opposed to a lot of the other institutions like the large REITs and the iBuyers, who I think are in many ways driving the inventory problem, I think we're actually mitigating it.
So essentially what your point is that the inventory you guys take on would never have been in the for sale market in any event.
Yeah, these people they're not willing to sell it because And we found, by the way, once a person has decided, like we've done enough of the sales cycles, once a person has decided, I'm selling my rental property, I don't care about the taxes I want out, they're selling it, they're done, and then, by the way, then it hits the MLS, and I mean, you guys know.
Yeah, that whole process.
Yeah. So Ari, I just want to follow up with one quick question on here, and I know Albert, and there are some other questions, but on that point, I mean, so you're really targeting a very niche aspect of the market then, right? You're targeting those asset owners who are already landlords who basically just want to retire from landlords, to your point, right? Like, it seems like you've defined who your ideal customer is, but how do you source them and how do they find you? Because again, I think to your point, it's a very unique place that you sit in the market that, I don't know that people are actually looking for it, right? So how do you go and find them, or how do they find you?
Yeah, I mean, it's a great question. So no one is looking for this because no one's done this before, And I like to go back to the Henry Ford quote, which is he says that if I had asked people what they wanted, they would have said a faster horse, right? Nobody was looking for a car.
Right.
What we found is when people hear about this, they say, wow, that's exactly what I need. I don't want to deal with this thing anymore. It's actually quite a large market. So it's just a couple kind of high-level statistics on the single-family rental market. It's roughly a $4.5 trillion market, of which 98%, despite all the institutional capital coming in, 98% of assets are owned by mom and pop investors. Or by individual investors, of which 80% of those people own 1 to 2 properties. So the vast majority of single family rentals are owned by mom and pop individual investors. And so and within those, there's various surveys done, but we found that more than 50% of people consider themselves either accidental owners, this according to Building, accidental owners, retiring landlords, or people no longer growing their portfolio who don't want to deal with it anymore. So it's a very, very large market. Obviously, Lynette, to your question, it's how are we going to source these people? How are we going to educate them on this, complex product that no one's ever heard of? And we believe over time, as we develop, it's my firm belief that if you build a really, really good product and you align the structural incentives in the market, so incentivize or develop partnerships with realtors, with property managers, and through some, really awesome tech, you can scale this business.
So, thanks for that.
Thank you.
I feel like I'm the idiot here because I don't understand a lot of these dynamics. I'm going to come at some of these questions as the typical person who doesn't really know what's going on. Okay.
Amazing. Yeah, these are this is most of my day is spent talking.
Yeah. I'm not
720. What?
Yeah. I mean, I think I'm relatively a smart person, but I'm looking at this and I'm like, oh man, I have so many more mundane questions. So sorry about the mundane question. My first mundane question is, so what do the payouts look like? Is it these guys aren't going to get monthly rent, it seems like, right? So is it more periodic, or is it just looking at kind of the appreciation of the fund?
Yeah. Great question. So this is exactly when you own an individual rental property, you get rental income at the end of the month. Flock collects all the rental income. We then hold back and pay out expenses for, as we said, insurance,
right.
Is property management. And then at the end of the quarter, we just pay out all the rental. We pay out the income in a distribution.
So it's a quarterly. Okay, got it. The second question I have is how liquid is this, right? How can I sell a piece? And how, if I were to sell it, then do I have to find the buyer? And right, yeah.
So the technical, right? So the technical term is redeeming. It's like selling, right? And yeah, we ask our owners to commit to an initial lockup period where they don't redeem, and that's we find that most people are literally coming to us because they don't want to trigger the taxes. So every owner is okay with that. And also we can waive we can waive that restriction. But yeah, then after a 3-year lockup, and let's say you say I want my money back, we'll do one of two things. We either sell the house and then we give you your money back, or we're raising separate institutional capital to allocate into the houses. So the way we meet your liquidity need is we either just sell the asset, which is very, very easy, or we'll draw. We also have a credit facility as well. So we have a lot of different capital sources. And then the most basic thing is we just sell the house.
Got it. So it'll be a little bit painful, right? Like it's not like I can be incredibly liquid with this.
Well, part of it is
unless you guys will back it.
No, I mean, it's, I can't come out and say it's going to be entirely, but the direction we're going and the business we're building, and our goal is to have it where as easy as the click of your app, you can just seamlessly convert it. And obviously the direction we're going is just like all the other publicly traded REITs out there. When we have that size and that scale, we build it so that you seamlessly convert this one individual asset into shares.
Love it, love it. So I know we don't have too much time, so I think we're gonna have time enough for like everybody to ask one more questions. I'm gonna do mine, and then I'll sit back. Again, this is like a dummy question, but what does the kind of corporate governance look like?
Before you ask that question, let me ask one quick little thing then.
Okay. All right. This is what's going to happen. We're all going to
sorry.
By the way, you guys, my only deadline is I have to get back to work, so we can stay over. I'm just like trying to build a business. But
in a redemption scenario, do you guys charge a fee?
Yeah, so we have a fee built in, and part of the reason for that is to ensure the integrity of the pool. So if we have to sell an asset, right, to meet liquidity, we have to pay the buyer's broker. So we're building that in. It is our goal over time to entirely eliminate that because then the shares move freely. But we built it in to protect the integrity of the structure.
So the redemption fee would be what, 2.5%, 3%?
Yeah, that's what we charge. But again, our hope is over time to just entirely. It's a safeguard purely.
Okay, and you're only taking on rental properties right now, or would you take on a property that's not a rental today? But could, in other words,
we actually have a couple scenarios where we've had individuals. We're doing one right now where someone didn't want to pay, like he just essentially rolled his primary residence in. He's doing a sale leaseback for a couple months, and then he's going to keep it just as an investment like investing in the market. So we'll take that, but we're really focusing on our core use case, our core need, our core user.
Okay, cool. That was it. Go ahead, Albert.
Yeah. So last dummy question. It's going to be a softball because it's come from me. So what kind of I don't know if corporate governance is the right term, but it seems like whoever's buying into this, like that they might be pretty active about it. Like, hey, what do you guys think? What are these decisions? I'm curious what your experience has been in the last year or so, I guess. And, when you're getting this together, how active are these people, right? Or how not active are they? And what kind of recourse do they have? This is not like a publicly traded company, but are there complaints? Are they like trying to say like, hey, don't buy that property because that's going to affect the price of this fund? I'm curious what that kind of decision loophole looks like.
Yeah, definitely. We're structured, as I said, as an operating partnership. We are the general partner, so we make all formal decisions. I think our incentives are very much a lot like our owners know. I mean, I think that the most important, like our first owners are just, my heroes. Like they built this with us, and our customer forever. They will be every owner that joins. They are just driving down the cost for every other owner, and that's essentially what we're doing. We're pooling these people together to create a newer, better way to own things. They don't have, once they join Flock, they don't have recourse. They don't get to say, wait, raise the rent on that tenant or don't fix that, right? So it's essentially trusting our management team to generate good returns for them. Yep. I think everyone understands that, what our goal is here and how to scale this thing, right? If we do a bad job managing these properties, we're never going to scale this business. And I think all our owners get that. And they've been tremendously supportive. We're really excited. We've had a really amazing first group of owners.
Awesome. Can I dive in next, Rob, before we wrap? All right, my last question. I want to bring it full circle to how Albert kicked off the conversation today, Ari, about, the whole component around the founding team and the DNA and the commitment to drive this forward and, you know, kind of give your life over to this for the next period of time. So, you know, you guys have done a tremendous job. So kudos to you. I do want to say that before we get off this call. I love the model. I love the concept too. And I'm so excited to see kind of how you guys build this out. So all the best luck there to you. But for where you are right now, what keeps you up at night?
Yeah. What keeps me up at night? Well, nothing keeps me up at night. I mean, I work crazy hours, but I also think it's really important to sleep and stuff. I think that, you know, right now, as I said, we're really focused. When you're running a startup, you can run in so many different directions. So like we could be running at growth and trying to, right? And we're really focused, as I said, on these first owners who entrusted us. We're really focused on the performance of the portfolio. We're really focused on building awesome tech to make this seamless and to make this a really good product. We're really focused on our residents. I mean, I know every single tenant, like, of all our properties right now, and I'm monitoring, you know, and obviously as we grow over time and the organization grows, that will diminish. But right now I'm super hands-on. And I think it speaks to, and Lynette, you were asking about our co-founders, all three of us, we all are aligned on the same thing, which we all have a really strong sense of duty. My one co-founder was a Marine. I am a former manager and also served in the military. My other co-founder also has a very strong sense of fiduciary duty. And I think when you look at what we're trying to build, it all comes down to that. And all the questions you guys asked today, which are phenomenal questions. Rob, your question on affordable housing and the impact we're having on communities, right? Albert and Lynette, your questions on our investor base, right? It all comes down to, if we don't deliver to those stakeholders, this business is never going to go anywhere, right? If we contribute to the lack of affordable housing in Denver, like, landlords aren't going to want to get behind us in Denver because they're going to hate us, right? And if we don't put up good returns, no landlord is going to want to turn their house over to Flock. And so I think that was a really strong ethos that our co-founding team, and then also every team member who joined Flock, is really aligned on, of like a really strong sense of duty to all the stakeholders, our employees, the community, the environment, our residents, and of course our owners.
Very cool. Thank you.
I don't actually have a last, dumb question. So I think I'm just going to thank Ari. I love this idea. Like I said, I love it, but to me, it's the whole of inventory issue. But to your point, if these aren't properties I would have ever hit this for sale market anyway, then maybe it's just really not that big a deal. All right. So, hey, Ari, thank you so much. This is awesome. I know Drew has dying to talk more about you. So,
no, Drew's amazing, and thank you guys. These were, first of all, amazing questions, and I thank you for the opportunity.
You know what? I do have one last dumb question. If anybody listening wants to get in touch with you or Flock, like, where do they find you? Yeah,
so you can email me, ari@flockhomes.com. You can call. I'll probably return the call. Well, someone else will maybe, but I will also. Email, LinkedIn, and please feel free to reach out. We're looking for awesome, mission-driven people, and people are excited about building like a really, what I think is a really like world-changing like enterprise here. So please do reach out.
Wonderful. All right.
Awesome.
Thank you, Ari.
Thanks, guys.
Thanks, Ari.
Appreciate it.
Yeah,
Take care of yourself. Take care of you guys, and just stay healthy. That's the one thing I want to say.
All right.
Definitely.
Thanks for the time, Ari.
Yeah, take care, guys.
All right. Thank you, Ari.
Now we're going to talk about you.
Yes, that's right.
All right. Thanks.
All right. Let's bring Drew on and talk about him. Drew.
Hey, Drew.
Drew.
Well done. I liked all. You had super good questions to ask him. I don't know where you guys want to.
Let's start with you. So you like these guys? You recommended them. Like, what do you like about them?
I mean, I've heard lots of stories from landlords around. I mean, it's increasingly in some markets, Seattle being one of them. There's lots of stories around just it's a huge pain in the ass to be a landlord these days, and like people are kind of selling specifically just because they're tired of the kind of bullshit, for lack of a better word, around kind of managing the unit and maintenance, regulation, taxes, everything associated with that. So I think this is like a super interesting kind of out for those people that doesn't involve selling, right? Like there are a considerable amount of kind of tax savings, and for the people that don't need the capital in terms of they don't need to go sell it to buy their next house or to fund a business or something, like they just want to relay it into a retirement fund. I think this is a very, very compelling financial instrument that I hadn't kind of seen before. And like I said, I don't like the word first or like only, because it's a word that's used way too often by startup founders, but I haven't seen anything kind of like this out there on the market.
Yeah, go ahead, Lynette.
Yeah, I hear you, Drew, and I'm just, the one thing that's been sort of poking at me like through the conversation, and I guess it's partly because we're in recruitment phase, right? So we're talking to a lot of startups right now. And what I love about this environment, and I love about this particular podcast, right, is there this program, is that, we're asking these questions, we're meeting these companies, we're kind of putting a face to, some of the people that are trying to solve some of these issues. But what's been poking at me in this one in particular, and it comes back to your point, Rob, around the whole affordability issue and the access to inventory. Like they're using the existing infrastructure to build this solution, for lack of a better word, right? And what actually bothers me is like, are we better off to actually change some of these reasons, like the 721 and the 1031? Like, are those the most efficient ways that we have, or ought we to be changing those to actually address more of the inventory issue? So we're not just trying to alleviate a problem a property owner has, but we're actually doing that and solving, an inventory issue at the same time. And I think to your point, I don't see that with this, right? All we're doing is it's a transfer of responsibility of that property is all it is. And it's not their objective, right? And I'm not laying blame on Flock. I'm just, I'm curious about these types of solutions and whether or not they are actually adding any additional value or efficiency to the marketplace, or whether there ought to be something else behind it, right? Like, I like, to your point, you even mentioned, an integration with Zavvy, Drew. Like this to me is a great bolt-on to another technology that can actually address an inventory problem or an access problem or an affordability problem, right? This is just a transfer of responsibility. And it's not like the tech. I'm a little bit like, I don't know how if it's tech enabled. I mean, you can do this now. Like the tech brings efficiencies, but great. Does it really solve a problem? I don't know.
So, I mean, I think here's why I kept saying I love this idea, because, I've been investigating this whole like institutions, funds, all that stuff for other things I'm doing. And yeah, it never occurred to me that you could do something like this, right? So for that group of owners who don't want to sell, and I think that's the key, they're not going to sell, right? They were never going to sell, but they want to keep sort of rental income coming in and benefit from the appreciation of the house. I think this is a really elegant, beautiful way of doing it. The business model makes sense. I'm a little surprised that he's not doing any sort of carry, because it feels like you should probably do some carry, but that's beside the point. On the other side, though, I almost have to take him at his word that these houses would have never hit inventory, But at the same time, I think about criticizing these guys from that angle. It's like, but what are, all these guys are doing is essentially democratizing BlackRock, right? I mean, we can't deny that. So I'm like, okay, that problem thing exists. Like, talk about building on top of infrastructure that already exists. Okay, we have, hundreds of billions of dollars in institutional capital coming in and saying, we want to invest in real estate, right? So if I'm the homeowner and somebody's coming and offering me cash for my house and $50,000 over asking, I'd be a fool not to take it. If I'm an agent representing that owner, I have to be a fool not to say you should take this offer. It's a no-brainer, right? And in all of that mix, what it does leave out, though, are the buyers, the first-time home buyers. It does leave those guys screwed. It's not Flock's fault that they're screwed. It's not
Not at
anybody's
all.
fault, right? So in a sense, I kind of feel like the greatest thing I could say about Flock, like I said, is they are bringing the power of these institutional landlords, like an Invitation Homes or like a BlackRock or whoever, to mom and pop investors, right? So that part I do like. The thing I don't like is the same reason I think I don't particularly like, the institutional landlords either, because I think the biggest risk that those guys have is political risk. And I don't know how to even account for that. And I don't know that that matters, because if political risk does come down, meaning some sort of huge tax or rent control or, something that prevents this sort of thing from happening, I feel like maybe those things could hit the individual landlords as well. So maybe it's just a wash. Do you know what I mean? So there's just something to think about.
I think one interesting angle, and Rob, I was kind of wrote about this exact issue a little bit. I mean, obviously it's kind of the topic du jour of the industry right now on the institutional side.
Yeah.
But one opportunity I do see is, like, I think it would be pretty interesting if Flock kind of enabled, and you talked about Carry, like enabled a bunch of micro funds and kind of people to run these and kind of build these funds on their own and kind of build some sort of super team of landlords, right? That's managing, I don't know, 50 properties or 100 properties or whatever, but not the thousands or tens of thousands of properties that these big institutionals have. Like, I think modernizing that real estate, like small and pop investor segment, is a pretty interesting opportunity. Mm-hmm. Same way Angel has kind of modernized the way people have done syndicates and kind of done micro funds. Mm-hmm. Like, they've made that a lot more accessible on the back end, because there's a bunch of legal kind of bullshit nightmare that you've got to deal with to, like, actually do that technically.
Sure.
So I don't know if that's the angle they're going to eventually get to, but I think that's one of the kind of very long-term possibilities that could make them, like, way more interesting on the tech side.
Yeah. And the only other thing I thought of is just a real picayune sort of technical thing, which is, if I'm a property owner, I'm a landlord, and even if I have property management on it, there are a whole bunch of tax write-offs that I can do just as an individual taxpayer that I don't think are available if I convert that into shares in a REIT. So that's a financial advisor type question. Do you know what I mean? Like, am I really better off going this way, or should I just, whatever, rent it out, but then I'm going to write off $40,000 worth of expenses because, they're property related. That's the only other thing I could really come up with. But Albert, you had something, yeah.
Can I jump in a little bit? So this is one BluePrint sessions where I definitely felt a little bit like I need to know more about this before I talk about it. But I will speak on kind of what, I can't speak for Ari, but the stage that they're at and some of the kind of issues that you guys are bringing up, I would feel a little bit like, hey, we'd love to be in that dilemma. Like, we'd love to be big enough where we're worried about, are we taking inventory off and et cetera. So it feels like a little bit theoretical and kind of more macro level than where they're at. So the place that I'd love to focus on is, like, where they're at right now and kind of what the appeal is to, the sellers, right? The customers that they're looking at. So just looking at that, like, I want to say it's incredibly impressive they have 20 homes, right? Mm-hmm. Like, it's incredibly impressive that they've somehow convinced 20 people to sell not to sell, but to trade their homes, right? Mm-hmm. I want to say that's incredibly impressive. B, I want to say, how were they able to do that? To me, it's like trust right now. Like, to me, it's about somebody has to be like, I really trust these guys, like these three guys, to be able to do the best, much better than I could do, right? And so,
I think you're ignoring what he said, though, right? Which is, look, the demand for this is really big out there, and I'm totally with him, right?
Right, absolutely. So what I'm saying is they're onto something.
Oh,
right?
for sure.
And a big part of the appeal, I think, even when there's a big, right, that there's somebody coming in saying, hey, I want to trade my house. I think, like, if I was that person, I'd want to look at this guy. I'd want to look at
for sure.
People. And the thing that I want to say right now is, I love Ari.
Yeah.
Super smart. Like, I would trust this guy. You know what I mean? So at this stage, it really matters what the team looks like. It really matters like how the face of this company is interacting with the customers. And it seems I'm like incredibly impressed by how, like I'm impressed by all these guys. By the way, I want to shout out to Drew real quickly. Like, dude, these founders are amazing.
Yeah.
They're amazing. And so, so especially in a business like this, what it seems like to me, again, is I need to have that conversation with Ari. And once I do, I think I would do it. You know what I mean? And that's really impressive. And it's really important, I think, at this phase. Later on, as they scale out and, face all these other problems, hey, that's the best thing that could happen to them, right? Like I think they would love to have to face some of those issues. I'll stop there.
I think they're potentially, and Rob, but you would know this better than me, but I think, relative to a lot of other prop tech startups or startups in general, right? Their biggest challenge is going to be sort of the long sales cycle of proving out their MVP. So they're using these 20 houses as their pilot, but in order to demonstrate the ROI to be able to kind of power that growth engine and their strategy forward, they're going to have to get not only the properties in, but they're going to have to start turning some revenues. And, and it's, I guess, the one question that they've been running this since 2018. I don't know how long they've had the size of the portfolio they have. And so, how are they able to demonstrate quarter on quarter returns or year on year returns, right? I think that's probably at the end of the day going to tell the tale, right? In terms of their ability to perform. And obviously they're iterating at the same time on the technology side. And he was pretty clear about that and saying, that's what they wanted to get right out front. But it'll probably take them some time to demonstrate that to then layer on top of the trust. So to your point, Albert, I mean, I think there's a trust factor, but then for a lot of people, it's probably their single biggest asset that they want to assure is going to land in a good place, right? So there's going to be a little bit of that time lag, I think, in their life cycle in terms of getting up and running and then their ability to scale.
I think there's some of that. The final thing I kept thinking about is because, I do this all the time with startups, right? Which is maybe it's probably the wrong thing to do, but I did my whole Shiva ranks thing, which is, right, like how disruptive are these guys? And if they are successful, right, who do they put out of business? Because I just don't believe that a startup could be that significant unless they're, like really changing something. Do you know what I mean? Like if you're just like a little, a little incremental add-on to something, okay, it's nice. You could maybe get to 20 million, but, to really make a difference. What I kept coming back to is if these guys are truly successful, right, I think they really put property management and realtors in real deep shit, right? I mean, I don't know how else to put it. Now, granted, today they want to work with property managers, they want to work with realtors, but I don't know. Drew, you laugh, so I mean, what do you think? Am I totally crazy?
I was thinking the exact same thing. Not so much on the realtors, but certainly on the property management side of thing. I got to think that this is a massive risk to them.
Yeah.
I think on the realtor side of things, another reason I really like this model is it plays into this long-term trend I've been thinking about for a long time, which is I really believe agents and brokers are going to have to become wealth managers, and they're going to have to figure out a way to kind of talk clients through scenarios like this and understand the 5 or 10 different options that they could do. And I think agents that don't figure that out are really screwed.
Well, I think, and I see that the flip side of that coin, Drew, in their ability to recruit the realtor, that's going to be one of their biggest in their growth mission. That's going to be one of their challenges, is how to educate realtors around that wealth management sort of component, because it's not how they typically see this. Like, right now it's, do you want to buy, sell, or lease your property? And real estate agents kind of know the ins and outs of that. But, do you want to, exchange your property? And here are all the different components. And this is why it's a great idea for your retirement strategy. Like, that piece just isn't there for them, right? And I think that's going to be a challenge that these guys will face just in recruiting the realtor, kind of population to help them with their cause.
Yeah, absolutely. I mean, I was speaking with someone from one of the kind of home equity startups yesterday. Same exact scenario of like, how the heck do you educate this population about what you do? Because I've talked to founders of pretty much every company in this entire space. And even I don't know exactly the differences between some of them and what's the specific use case they're focused on.
I'm back.
So, I mean, if I don't know, like, how can you possibly expect an agent to understand the 10 different options and when to mention which one?
Yeah.
I mean, there's a startup business in there, I think, right? Like somebody can portalize that and be like, here are all the different choices. There's like, I mean, one thing that popped up to me was Rabu when I first heard him, like, right? And so like, hey, you know, if there are all these potential solutions, then in the end, you're just asking about what's my return and how much effort do I have to put in for that return, right? And that's really, I think, what the calculus is. And so if these guys can be like, hey, we're a really good option, right? Compared to property management, compared to Rabu, compared to me doing it, you know, whatever, right? Like that seems pretty, like, you know, pretty.
All right, so
simple, doesn't it?
So I'm sorry, my internet dropped. Can you guys hear me? Okay. All right. Yeah. So I missed what Drew said. Drew was like, "I've been thinking of believing," and then I dropped out. So hopefully I didn't miss that. But one other thing that occurred to me as I was waiting for my internet to come back, there's a real danger here for them, right? For Flock, that has more to do with the property management side. Okay, let me explain what I mean by that. One of the issues that we have, all of us, society, you know, the industry has with institutional landlords like a Invitation, like, you know, some of these guys, is they don't treat tenants all that well. And there have been a whole bunch of stories, like media stories around from like New York Times and all this stuff. And it's for obvious reasons, because those guys owe a fiduciary duty to their investors to maximize returns. Well, there are only so many ways you can maximize returns in a rental situation, right? Obviously, you could do efficiency and blah, blah, blah. There does come a point, though, where you just go, we're just going to raise rents, right? We're just going to raise rents, and we're going to do less repairs. And there have been horror story after horror story. Now, Ari, I don't know the rest of his team, but Ari strikes me as a really good dude, you know, and I think he will do everything he can to make sure the tenant experience is awesome. And he said he knows all the tenants, right? I'm like, yeah, that works when you have 20 homes
in the first
Denver.
20.
Right. You get to 20,000, and then now you have pressure to generate returns, right? With an individual landlord, right? Because this is what ends up happening. An individual landlord is much more likely to be more forgiving or be more, oh, you know what, you've got this situation going on. You know, they're much more likely to be, this is my property and I want to make sure it's in the best possible shape. When you put that into institutional pool, now that kind of gets removed. I'm not saying they can't solve this problem, and I'm not saying they're going to have this problem, but it is a problem we've seen in other institutional landlord scenarios. And I do think there's something that we haven't really talked about, because I don't know how to talk about it without insulting the man, but it is something that I think we have to think about, right?
Well, and I think the other
he's aware of
component
it
of
too,
this,
though. Yeah.
What's
sorry,
that?
Lennon.
well, the other component of that is, you know, as you expand out of one marketplace, how do you make certain that you have that same operational consistency across the board, right? You need on the ground suppliers and rev share. And so, and I mean, you know, the great thing is there are lots of opportunities and options now to integrate with other solutions. You know, you think about Thumbtacks and the rest of it, and, you know, kind of the home services piece. So, you know, I think there's that opportunity, but you're absolutely right, Rob. There's a fine line, because before you get there, you have to get the consuming public to get on that page as well.
Yeah.
And I think it's part of their scale. It's part of their scale challenge. Totally.
Yeah. I mean, so I think that's a great question. I had the same question in my mind. Like, there's two pieces of this business, right? There's the operational piece, and then this like fund management piece. And the expertise is different for these. And so like, and then there's a plus. The plus of doing both is that you control that, right? That's a huge plus, by the way, instead of like, you know, doing like affiliates or like a third party or whatever. Like, that seems like the easy solution, but actually when you're on the ground doing that, it's really painful when you have partners doing this business, right? So it's really easy to be like, hey, form a lot of partners. But being in a startup, I mean, you guys know this, it's painful to have partners and affiliates and people doing like this stuff. And it sounds great in the beginning, but they do a bad job. Then, right? And you don't control it. And
your whole business depends on the partner's performance. Like,
right. So I think it's right that they're jumping into this operational piece. And I don't know if I'm gonna bring my golf, bring my golf thing. So golf courses, it's the same thing, right? You have these huge management companies that are starting to buy up golf courses and do the same thing. And in general, it's been negative. In general, people are like, dude, as soon as these guys buy up this course, it turns into crap. They don't take care of it, right? They're probably making more money. And during COVID, they're protecting themselves from bankruptcy, et cetera. But the experience is so bad that people are starting to say, hey, once like this institution takes it over, it just goes to hell, right? And so there's a real brand problem. I don't think that same brand problem though applies in this case, right? Like, I don't think there's going to be, right, people who are like, I'll never rent a home from these guys because they've always run it into.
Dude, I mean, you got to look at some of the stories that's in the media right now. It's not necessarily about I'm gonna never rent from these guys. It's more like I'm gonna sue these motherfuckers. Right. Yeah. And I'm going to file consumer complaints. I'm going to take it up with my legislator. Again, this is not Flock. These are other institutional landlords that have been written up in like Wall Street Journal, New York Times, some of these things. So it's just something to really think about.
Yeah, I totally agree. There has to be I did want to ask more about these operational pieces, right? How are they good at it? And his answer is that they are putting like a crazy amount of effort into it, and they have people who really know the business. But it definitely, I agree with you. I think it definitely gets complicated at scale. And when you're fighting like to be awesome operationally, that's a huge battlefront, right? Then you're fighting with a lot of existing people.
Well, and the one piece we never really got into was the tenant experience, right? We never got into that component. How do you find tenants? How do you onboard tenants? How do you manage the properties? And so if I'm a landlord, if I'm a property owner and a current landlord, I don't know how this makes it better for me other than somebody else is managing my asset. And I don't I don't know if that whole experience
it's beyond that, right? Because that's what you would think about if you're hiring a property management company.
Yes.
This, you no longer have an asset. This, you have essentially sold your asset to this fund and now you own shares of the fund, right?
And I hear you. So I guess my point is, like, it makes it better for the landlord, but does it make it better for that experience? Because I don't know, right? Like, they become another property manager.
They are.
Essentially.
They are.
Right?
Except the property manager who, like I said, they don't have the leeway. In other words, even a property manager, so let's say I'm a landlord, I go hire a property management firm. The property management firm comes to me and says something like, hey, the toilet needs to be replaced, right? How do you want to do this? I, as a landlord, could say, you know what? I want what's best. I want the best quality. So go out and spend a little extra money, take it out of my fund because I want my tenant to have an awesome experience. Under this model, I never get that phone call, right? Instead, the head of operations for Flock gets the phone call. We have the toilet situation over here. Now, at that point, does Flock then say, you know what? We want the best possible experience of tenants.
Exactly.
Go spend that money. Or do they do hey, our fiduciary duties to our investors, to our owners, so therefore go spend as little money as possible so we can maximize returns. That is a challenge that's not technology. It's not even operational. It's financial, and it has to do with what sort of messaging, what sort of expectations are they able to set with the former landlords who are now their investors.
So let me ask you this question then. Is there competition on the supply side or the demand side? Is there competition? Nobody else in the market is bringing this solution to the table for the current property owner who wants to just continue to reap the reward on that asset? Or is there competition every other property manager in the landscape, including the institutionals? Because at the end of the day, what makes the decision, right? Because they're going to have to your point, there are only so many levers you can pull to make this thing profitable. So I'm like,
it's a great question.
I'm only asking these questions because.
But you know what? As Albert mentioned, I'm sure that they would love to get to that point.
And I want to say right now for them and to speak to that, and that was my question, right? Like, why would I choose these guys over all these other solutions? And to me, it's trust. It's like, and it has to be this person. There has to be a sales job right now, right? That at this very early level, where all the customers are like, dude, these guys know what they're talking about. They're awesome. They made it painless. They're putting money in my pocket, right? And that's the same with every startup, right? You have to focus on those early customers. And that's the stage they're at. And as far as that's concerned, I was just, I'm like, I would trust this guy with my money. I would trust him. He like knows what he's talking about. He has the background.
Yeah.
And so that's really important, right? That kind of human level at this stage. Yeah. And so, not going too far, I again want to say, and I feel like I'm always like, oh, these founders are awesome, but they are. And it seems like these guys that he's a good fit, right? Like he's a good fit for exactly this kind of business. I couldn't see any other type of founder being able to do this business. So I want to say a big, hoorah to that. You know what I mean? Like that fit looks really good. And there's a good reason why he's getting institutional funding, in my opinion.
Yeah, for sure.
I would have funded these guys too.
All right, Drew.
Can I just jump back to the tent side of things quickly? So one idea as far as kind of what could they're not doing this today, at least from what I can tell. But one thing that they could do is they could turn tenants into owners in the fund, which is actually something Arrived Homes was doing to start with. They've since shifted and are now selling shares of individual houses because it's massively complex, right? To like raise a fund, do that whole business, and also kind of like add a component to the renter, like the tenant side of the equation, to like every month get them $100, $200 credit into the fund. But that could be one interesting way to differentiate them in the market. Like Rove is kind of doing this at big multifamily buildings, but no one's really doing it for single families that I've seen.
So what would they have to do differently than Arrived did to make it viable if Arrived just shifted the model?
I don't know. I mean, I feel like they have a unique angle on getting the inventory, right? Like the 721 is something that Arrived wasn't doing, at least. Maybe they tried it. I don't know, but like, it seems like they have a small base of properties to go from, and if they have that side of the equation solved, then I think the tenant side becomes easier. But I think leading with the tenant side is a challenge. I think like trying to get tenants to go into this model and then acquire an inventory is very different than like, hey, we already have this inventory and we're going to rent it out with or without this thing.
Yeah.
I have a broader question that I want to ask you guys.
Okay.
So,
because I gotta run fairly soon. So ask. Yeah. No, I got a few minutes.
I'm curious, like, again, me not being an industry expert, I'm curious if this business model, and a lot of business models like this, right? Like, what do I do with my assets in this time of like boom, right? Is this like a cyclical thing? Do you see this something, these kinds of businesses, doing better over time? Like it seems like we're in a pretty unique situation, right? Like low inventory, high home prices, et cetera, very much like a seller's market. And wondering if, over time, you guys see this continuing to be like this, or if, can this business like die if all of a sudden, right, it goes back, right, for whatever reason, maybe government involvement and so forth?
I don't think any of the companies we've spoken to are cyclical, like especially Flock. Flock is not cyclical, right? Because
I would argue that they actually normalize the cycles.
Yeah, and again, whether cycles are up or cycles are down, I mean, people are going to rent because everyone has to live somewhere, and if you don't own, you got to rent, right? So I don't see it like that. I think the bigger, and every one of these companies, there's political risk, right? I do think that that's the biggest risk, if you will, right? But I don't see it being cyclical in that sense. Like maybe someone like like Rabu, right, which is more like short-term rental. Like maybe that's a little bit more cyclical. I can't say, but even that I don't think so, right? Because it's just so established now. Like the society has come to. I'm gonna go rent this house, for a month, or for a weekend. So I don't actually see it being cyclical. I do think every one of the companies we talk to, I think their biggest risk is basically political, because real estate is so regulated and it's just so fundamental. It's so important. Do you know what I mean? We're not talking about like MP3s or some video game. We're talking about people's homes. Like it's just so political. That's what I'm thinking.
Yeah, and if I can just layer on the experience, and it's not different in the US, although I would say that in Canada, gas has been poured on this particular sector. the government in Canada has been making a shitload of regulatory changes around mortgages.
Yep.
And it's like rapid fire. And so guess what we see? We see a ton of software companies popping up that are trying to crack that nut, right? And just facilitate kind of the upheaval or take advantage of the upheaval, I guess, whichever way you want to look at it, of all of those rapid fire regulatory changes right now. Will we see fewer of those companies? My guess is we'll rationalize it and then to a certain number, and then they will evolve. But I would agree with you, Rob, and I think it comes back to a comment I made earlier around this particular platform, right? They're really just enabling people to take advantage of the current regulatory environment, notwithstanding that it's been there for decades,
right?
But it can change tomorrow.
Right.
And if it changes tomorrow, that's where their risk lies.
Correct.
Is that their entire model is predicated on access to the 721 exchange and stop.
Correct.
So, and that, who knows when it changes. So you place that bet and you hope you're able to pivot with whatever change and it's within your power. And
that's right.
You kind of roll from there.
That's
right.
But then again, every company,
totally
does that. Like, look at vaping companies. They were doing great. And then they just started coming after them, and now they're not doing so great. So, it is what it is.
But you are doing your best, my friend, to keep them in business.
I am. Good for you. I am. Albert, because, it's better them than big tobacco. That's how I look at it. So,
Totally.
Anyway, hi, guys. This was awesome again. Drew, thank you.
Thank you, guys.
Thanks to Ari and Flock for willing to come on and talk to us. I really think there's something there. So I'm excited to see where they go. All right.
We need to do a after the end of, I don't know, maybe in a year, we need to do a roundup and see where everybody's at.
See where everyone's at. That'd be awesome.
Yeah.
Okay.
Totally. Okay, guys. Love y'all.
Take care, everybody.
Bye, guys.
Have a good day.
Bye.
Bye.